What if everything you've been taught about money is the very reason you're not building it? Think about that for a moment. Think about the millions of people who wake up before the sun rises, who commute to jobs they tolerate, who grind through long hours and skip vacations, and tell themselves that one day all this hard work will pay off. And yet, month after month, year after year, the bank account stays thin, the bills stay heavy, the dream stays distant. This isn't a story about lazy people. This is a story about hardworking people. People just like you. People who were told the same thing their entire lives. Work hard, save a little, and everything will be fine. But what if that advice, repeated by parents, teachers, and bosses for generations, is quietly, systematically keeping ordinary people trapped in a cycle they don't even realize they're in? Here is the uncomfortable truth. Hard work alone has never made anyone wealthy.
In the next several minutes, you're going to discover the hidden reasons why so many dedicated, disciplined, hard-working people never achieve financial freedom. You'll learn the psychological traps that keep most people spending more than they build, the wealth principles that separate the financially free from the financially stuck, and the practical strategies that can genuinely change the direction of your financial life, starting today. Stay with us until the very end, because the final lesson we share may be the most important financial insight you've ever encountered. It's rarely discussed, almost never taught in school, and yet it's the single factor that separates those who build lasting wealth from those who simply stay busy their entire lives. But before we dive in, if you're serious about building wealth, understanding money on a deeper level, and creating multiple streams of income that can work for you even while you sleep, subscribe to Elevana Wealth right now and turn on your notifications. Every single week, we publish content designed to give you real financial education, practical wealth-building strategies, and the kind of insights that most people only discover far too late in life. This channel exists for one reason: to help you move closer to the financial freedom you deserve. Now, let's get into it. Let me tell you about a man named Daniel. Daniel was born into a working-class family in a mid-sized city. His parents worked hard, his father at a factory, his mother as a school aide, and they instilled in him the same values that had been passed down through their family for generations. Show up, work hard, don't complain, be responsible. And Daniel did exactly that. He got decent grades, landed a stable job in his mid-20s, earned promotions, worked overtime when it was offered, and never missed a payment on his bills. By 40 years old, Daniel was earning more money than either of his parents ever had. He was, by almost every visible measure, a success. But Daniel had a secret that most people around him didn't know. He was broke. Not broke in the traditional sense. His lights were on, his car was running, his family was fed. But he had almost nothing saved. No real investments, no assets working for him. One lost paycheck away from genuine financial hardship. At 40 years old, after nearly 2 decades of hard, disciplined work, Daniel had almost nothing to show for it in terms of lasting wealth. What went wrong? Here is what most people never stop to examine. Daniel had been taught how to earn money, but no one, not his school, not his parents, not his employer, had ever taught him how money actually works. And that distinction, that single gap in education, made all the difference. Daniel's story is not unusual. It is, in fact, remarkably common. And today, we're going to break down exactly what keeps people like Daniel, hardworking, well-intentioned, disciplined people, from ever crossing the line from income to wealth.
Lesson 1. Confusing activity with progress. Here is something that very few people ever stop to consider. Being busy and moving forward are not the same thing. In fact, for many hardworking people, Being constantly busy is actually the thing preventing them from making real financial progress. Think about it this way. You can work 40, 50, 60 hours a week and still be running in place if you are simply trading your time for a fixed amount of money with no residual return. The activity feels like progress. It feels responsible. The exhaustion at the end of the day feels like proof that you're doing something right. But busyness without a wealth strategy is just motion, and motion is not the same as direction. The wealthiest people in the world are not necessarily the ones working the hardest hours. They are the ones who have built systems, businesses, investments, assets, intellectual property that generate returns whether they are present or not. They stopped selling only their time and started building things that compound over time. The practical shift here is not to work less. It is to start asking a different question. Not just, how much can I earn this week, but what am I building that will still be earning for me in 5 years? Consider someone like Warren Buffett. While he is certainly known for his work ethic and discipline, his great wealth was not built by working more hours than everyone else. It was built by making intelligent decisions about capital allocation and then allowing time and compounding to do the heavy lifting. He once said that if you don't find a way to make money while you sleep, you will work until you die. That is not pessimism. That is financial reality. This is the first crack in the foundation. Hard work without a wealth-building strategy is a full life of effort with an empty balance sheet at the end. But here is where it gets more complex, because the problem goes deeper than strategy.
Lesson 2. The Trap of Lifestyle Inflation. Now, this is where things become genuinely interesting and genuinely dangerous for most people. As people earn more money, almost automatically, almost invisibly, they begin to spend more money. A raise arrives, the car gets upgraded, the apartment gets bigger, the vacations get longer, the dining gets fancier. This phenomenon has a name: lifestyle inflation, and it is one of the most silent and effective wealth destroyers in the modern world. The reason lifestyle inflation is so psychologically powerful is that it feels like a reward. It feels like the natural result of working hard. And in a society that constantly tells you that success looks like a certain kind of home, a certain kind of car, a certain kind of wardrobe, the pressure to spend your additional income on visible symbols of success is enormous. But every rupee, every naira, every dollar you spend upgrading your lifestyle is a unit of wealth that is no longer working for your future. It is spent, gone, unable to compound. The practical strategy here is to implement what some wealth coaches call the 50% rule of income growth. Every time your income increases, commit to directing at least 50% of that increase towards investments, savings, or asset creation before you adjust your lifestyle at all. Not after. Before. Make the wealth decision first, and then enjoy the remainder. Most people do this backwards. They upgrade the lifestyle immediately and tell themselves they'll invest whatever is left over. Almost nothing is ever left over. Think about the entertainers and athletes who earn millions of dollars over the course of a decade and retire with nothing. This is not a problem of insufficient income. It is a problem of lifestyle inflation outpacing wealth creation every single time. The income was enormous. The spending was simply larger. Now, if lifestyle inflation is about what you spend, the next lesson is about what you think, and it may be the most important lesson of all. Lesson 3. The Scarcity Mindset and its Hidden Cost. Before we continue, there is something important you need to understand about the human brain and its relationship with money. Most people who grew up in households where money was scarce, where financial stress was a constant background noise, where conversations about bills were tense and tight, carry a subconscious programming that shapes every financial decision they make as adults, often without realizing it. Psychologists call this the scarcity mindset, and it is not just an attitude. It is a deeply wired cognitive pattern that literally changes how the brain processes decisions related to money and opportunity.
The scarcity mindset causes people to focus intensely on immediate financial survival at the expense of long-term financial planning. It causes people to avoid investing because the brain interprets putting money away as losing it. It causes people to distrust financial systems, avoid calculated risks, and remain in employment situations that feel safe, even when those situations are keeping them stuck. In short, the scarcity mindset makes it very, very difficult to make the kind of bold, strategic financial decisions that create wealth. The first step in dismantling a scarcity mindset is awareness. Begin noticing your emotional responses to financial decisions. Notice when fear or avoidance shows up. Notice whether your financial decisions are driven by what you want to build or what you are afraid of losing. Then intentionally begin exposing yourself to abundance thinking, reading about wealth creation, surrounding yourself with people who discuss money in terms of opportunity rather than threat, and beginning even small investment habits that train your brain to associate financial action with growth rather than loss. This shift in mindset was at the core of every major personal wealth transformation story. The income changed last. The thinking changed first. And the thinking change is available to anyone regardless of where they started.
Lesson 4. The employee mindset versus the investor mindset. Pay close attention because this next lesson is where everything begins to change for most people who finally break through financially. The employee mindset says, I will trade my time and skills for a predictable income. Security is the goal. Stability is the priority. This is not a flawed mindset. It is a perfectly rational one, and it provides enormous value to the economy. But as a standalone financial strategy, it has a fundamental ceiling. There are only so many hours in a day, and time, unlike money, cannot be reinvested. The investor mindset says something different. It says, I will use my income not just to sustain my life, but to acquire and build assets that generate additional income. It looks at every dollar not merely as something to spend or save, but as a potential worker, a unit of capital that when deployed intelligently can generate returns that hire additional workers, and so on. This is the mechanical difference between a paycheck and wealth. The practical bridge between these two mindsets is the concept of pay yourself first. Before you pay your rent, before you buy your groceries, before you cover any lifestyle expense, a designated percentage of every dollar you earn goes directly into an investment vehicle of your choosing. Index funds, real estate, a business you are building on the side. The specific vehicle matters less than the habit itself. The habit of automatically moving money from income to investment is the behavior that over time builds asset bases large enough to generate meaningful passive income. Andrew Carnegie, one of the wealthiest individuals in recorded history, was once asked what the secret to building wealth was. His answer was startlingly simple. He said, spend less than you earn, invest the difference, and never touch it. The strategy has not changed in 150 years because human nature has not changed. The math is the same. The discipline is still the variable. Lesson 5. Financial illiteracy, the silent epidemic. Very few people ever talk about this openly, and that silence is part of the problem. The majority of the world's population reaches adulthood without ever having received a single structured lesson in personal finance. Think about the thousands of hours spent in school learning subjects that will have limited practical impact on most people's daily lives, and then think about the fact that almost none of that time was devoted to teaching young people how compound interest works, what an index fund is, how to read a balance sheet, what the difference between an asset and a liability is, or why debt can be both a tool and a trap depending entirely on how it is used. Financial illiteracy is not a personal failure. It is a systemic one, and its consequences are enormous.
People who do not understand money make predictable and expensive mistakes. They carry high-interest debt for years without realizing how much it is actually costing them. They avoid investing because they don't understand the options available to them. They make large purchases on impulse without understanding the long-term cost. And they reach retirement age having never built the kind of asset base that could sustain them without employment. The practical response to financial illiteracy is simple and immediate. Invest in your financial education the same way you would invest in any skill that increases your earning power. Read one book on personal finance every month. Watch educational content consistently, and that includes content exactly like this. Follow people whose financial results you want to replicate and study not just what they have, but how they think. Financial illiteracy is not an innate talent. It is a learned skill, and once learned, it never stops paying dividends.
Lesson 6. The debt cycle. When the system works against you. What happens next in most people's financial lives surprises them deeply, usually when it is already too late to easily reverse. Consumer debt is one of the most effective wealth transfer mechanisms ever designed. Every month that a person carries a high-interest credit card balance, they are literally transferring a portion of their earned income directly to a financial institution. The average consumer credit card in many countries carries an interest rate of between 18 and 24% annually. Meanwhile, the average stock market return over the long term is approximately 8 to 10%. This means that someone carrying significant consumer debt who is simultaneously trying to invest is fighting an uphill battle. The debt is destroying wealth faster than the investments can build it. This does not mean all debt is destructive. There is a powerful distinction in the world of wealth building between bad debt and good debt. Bad debt is borrowed money used to fund consumption, lifestyle purchases, depreciating assets, things that lose value the moment you acquire them. Good debt is borrowed money used to acquire assets that generate income greater than the cost of the debt itself. A rental property, a business investment, certain forms of education with clear income upside. The wealthy understand this distinction intuitively. Most people were never taught it. The strategy here is aggressive and sequential. List every debt you carry, organized by interest rate from highest to lowest. Commit every available dollar above your minimum payments to eliminating the highest interest debt first. Once it is gone, redirect that entire payment toward the next debt. This approach, often called the debt avalanche method, eliminates consumer debt as quickly as mathematically possible and frees up income for wealth building far sooner. Freedom from high-interest debt is not just a financial milestone. It is the moment the math begins to work in your favor instead of against you. Lesson 7. The power of multiple income streams. Here is the reality that the wealthiest people in the world have understood for centuries. One stream of income is not wealth. It is a single point of failure. Research consistently shows that the majority of millionaires maintain multiple streams of income simultaneously, typically between 3 and 7 distinct income sources at any given time. These streams tend to include active income from a primary profession or business, passive income from investments, rental income from real estate, royalty income from intellectual property, and profit participation from equity in businesses or side ventures. The specific combination varies. The principle does not. Building a second income stream does not require starting a corporation or quitting your job. It requires identifying a skill, knowledge base, or asset you already possess that other people would pay for, and then building even a modest system around monetizing it. This could look like freelancing your professional skills online in your evenings. It could look like creating digital content that builds an audience over time. It could look like purchasing a single rental unit, even a modest one in an affordable area, that generates monthly cash flow. It could look like buying dividend-producing index funds with every surplus dollar you have. The key is to begin. The first additional stream of income is always the hardest to build. After that, the knowledge, confidence, and capital to build the next one compounds as well. Now, before we reach the most powerful part of today's conversation, pause for a moment and consider this. everything we have discussed so far. The busyness trap, lifestyle inflation, the scarcity mindset, debt cycles, financial illiteracy. All of these are problems that exist inside a person's relationship with money. But there is one final and foundational issue that sits underneath all of them, and it is the one almost nobody talks about. Lesson 8. Time, the asset most people waste without realizing it. If there is one thing that genuinely separates those who build wealth from those who do not, it is not intelligence. It is not talent. It is not even discipline, though discipline matters enormously. It is time. Specifically, the decision about when to begin. Compound interest is one of the most extraordinary forces in the financial world, and it is also one of the most misunderstood. The principle is simple. Money invested earns returns, and those returns are reinvested, earning returns of their own. Over time, this creates an exponential growth curve, one that starts slowly and then accelerates in ways that feel almost impossible to believe until you see the numbers. Consider this. Someone who begins investing a modest amount at 25 years old and maintains that habit until 65 years will, in most realistic scenarios, accumulate 2 to 3 times more wealth than someone who waits until 35 years to begin the exact same habit with the exact same amount. 10 years. That is all that separates them. Not intelligence, not income, just 10 years of compounding that the second person gave away. Every year you delay beginning your investment journey is a year of compounding lost forever. You cannot recover it. You cannot earn it back. You can only decide right now, today, that the next year will not be wasted the same way. The best time to begin building wealth was years ago. The second best time is right now, in this moment, while you still have time on your side.
So what do you actually do? Let's make this concrete and immediate. First, calculate your net worth today. Not your income, your net worth. Add up everything you own that holds value. Subtract everything you owe. This number, however uncomfortable it may be, is your real starting point. You cannot navigate to a destination without knowing where you are. Second, create a written spending plan. Not a budget designed to restrict you, but a conscious allocation of your income toward your priorities. Every dollar should have a designated purpose before the month begins. Include a mandatory investment allocation in this plan, even if it starts at 5% of your income. Make it automatic. Remove the decision from the equation. Third, begin eliminating your highest interest debt with intensity and urgency. Every month that debt remains is a month of wealth transfer happening in the wrong direction. Fourth, open an investment account if you don't already have one. Start with index funds, broad market, low-fee instruments that give you exposure to the overall growth of the economy without requiring sophisticated knowledge to operate. Invest consistently, regardless of what the market is doing. Consistency over time beats timing the market every single time. Fifth, start building your first side income stream. Identify what you know that others would pay to learn or use. Spend 10 focused hours per week building that stream. Not browsing, not planning, building. After 12 months of consistent effort, evaluate, adjust, and continue. Sixth, commit to reading one personal finance or wealth-building book per month for the next 12 months. The education will compound along with the capital.
Let's bring everything together. Most people stay broke not because they are lazy, but because they are playing a game they were never properly taught to play. They confuse activity with progress. They inflate their lifestyles as their incomes grow. They carry a subconscious scarcity mindset inherited from their environments. They remain locked in an employee-only financial model. They lack the financial literacy to make their money multiply. They carry consumer debt that quietly transfers their wealth to others. They rely on a single stream of income, and they delay beginning their investment journey until the most powerful years of compounding are already gone. Every single one of these problems is solvable. Every single one of these patterns can be broken, but breaking them requires something that hard work alone will never provide. It requires financial education, strategic thinking, and the courage to begin making different decisions even when the people around you are making the same old ones.
The path to financial freedom is not paved with longer hours. It is paved with better thinking, earlier action, and the consistent application of principles that the wealthy have understood for generations. And now you understand them too. Now we want to hear from you. Which of the lessons we discussed today resonated with you the most? Was it the lifestyle inflation trap, the scarcity mindset, the power of building multiple income streams, or was it the sobering reality of time and compounding? Drop your answer in the comments below. We read every single one, and your answer might inspire someone else watching this video who needed to hear exactly what you have to say. And if you have a specific question about any of the strategies we covered today, leave it in the comments as well. Your question might become the subject of our next video.
If this video brought you value, if it shifted even one perspective, clarified one concept, or gave you one strategy you didn't have before, then subscribe to Elevana Wealth right now and turn on your notifications. This is what we do here. Week after week, we publish content specifically designed to help you build real wealth, create multiple streams of income, understand money at a deeper level, and make the kind of financial decisions that your future self will be genuinely grateful for. This community is growing, and we want you to be part of it. Subscribe, share this video with someone who needs to hear it, and come back next week for more. And remember this as you go. Income can make you comfortable, but assets, the things you own that work while you rest, those are what make you free. Hard work is admirable. It is necessary, but it is not sufficient. The world is full of hardworking people who are not wealthy, and wealthy people who don't work nearly as hard as you do. The difference is not effort. The difference is knowledge, strategy, and time. You now have the knowledge. The strategy is in your hands. The only question that remains is what you do with the time you have left. Start today. Start small if you must, but start. Your future wealth is not waiting for you to work harder. It is waiting for you to think differently.